I'm really excited today to welcome you all to our webinar on delivering investment outcomes in a volatile market. There have been a lot of changes going on, as we've all seen. We've spent the last few years, firstly, we had COVID year 1, COVID year 2, and then even, I guess you could nearly say COVID year 3 last year. Here we are coming into a new year, and then we thought we'd throw into the mix a bit of economic upturn and some challenges like that. So today we're really excited to have Jody Fitzgerald joining us from Morningstar, and also Richard as well. So thanks very much for joining us. I'm just going to go through and just my background. I actually think I know nearly everyone on the webinar today. So thanks to all of our clients that have turned up. I think you're going to get a real treat today with listening to Jody. So Jody has a CV or a bio that goes a mile long. She is actually probably considered one of the top experts in, well, I think you're the top expert in all of investments, Jody. So she's the head of institutional portfolio management at Morningstar. Basically, that means she is the head of where does Morningstar do all of their investments? What do they invest in? Why do they invest in a particular area? But the one reason I asked Jody to present today to our clients, I think I probably begged you and you said yes straight away anyway, but I had this whole speech lined up as to give you the 50 reasons why you needed to do this for me, is because every time I see that Jody is presenting, I'm literally always there to listen to what she has to say. It seems like, you know, we caught up a few months ago. Everything Jody said is happening. So her crystal ball works a lot better than mine. You know, there's no guarantees on crystal balls. But also, I think what you'll find today as well is Jody has this ability to take what can be very complex areas, complex strategies, and bring it into what we like to call is like people language, and explain it in layman's terms so that we can all understand it. So I'm really excited, and thank you so much, Jody, for taking the time out, because I know that you are very busy when you're doing all of those funds under management that you are doing, but we do really appreciate it in having someone at your level to talk to our clients. So I'm going to hand over now and make Jody the host, and hopefully this part all works, the technology part. Okay.
It could be our undoing, right?
Okay.
Now I'm going to apologize in advance for if I cough. I'm in a process of getting over a bit of a cold. Can you see my screen? Can you give me a thumbs up?
We can. Yes, we can. Yeah.
Oh, brilliant. Yeah, so if I do cough at some stage, I apologize in advance. I've got some water here ready to go though. Okay, so thank you for joining us this afternoon. And, you know, as Shannon mentioned, there's a lot happening at the moment in the markets, but then also globally with regards to what's happening with economies, inflation, unemployment rates, etc., all of which feed into how markets behave, and then ultimately feeds into how we behave as investors. And sometimes as investors, we may not necessarily behave in the right way because we get nervous in the face of negative news flow. And there's certainly no shortage of negative news flow at the moment. So I thought it'd be good today just to step through and unpack effectively what's been happening in the world and how that would be impacting investment markets. And then ultimately what we are actually doing it from an investment perspective. So just as a general disclaimer, it's important to understand today that anything that we say is just in general in nature and it does not constitute any personal financial advice. Before I launch into what's happening in the world, I think maybe it's worthwhile just giving you an understanding of who Morningstar is and the partnership that we have with Shannon and the team. We are actually, some people may know us, we're a globally listed company on the over in the US. Chicago is basically where our head office is. We're actually a relatively large global asset management firm. We have 240 odd billion under management. Now, that's quite a substantial amount. What we actually have though backing that investment is probably what's absolutely key for you, is with regards to there are 107 people like me around the world who are basically portfolio managers who have our hand on the wheel of the portfolios. The portfolios that we help build, you know, for Shannon and the team to use in your portfolios, there's 107 of us who are fully focused on understanding what is happening in the world, what is happening in markets, and therefore how should we be positioned. We then have the ability to tap into 150 manager research people. So these are people who will go out and look at different external managers and determine whether or not they're capable of generating decent performance. And then also 600 odd equity and research analysts. So all of that comes together to actually build out a final investment portfolio for you and for the clients of Shannon's business. So, sorry, I was trying to. So what's going on in investment markets? That's what we're here today to really talk about. So, what we have here is basically how investment markets have performed so far this year. And the thing that you'll actually note is that it's a sea of green. Now, that's actually really, really interesting, because if you've been paying attention to investment markets or just to the economy in general, you'll note there's been a lot of negative news flow. We've had huge levels of inflation. That has actually then degraded people's real incomes. So in other words, your wages haven't been keeping pace with inflation, and therefore you can't buy as much. Property values have actually been falling. There's constant calls that there'll be a recession here in Australia, globally, all around the world, particularly within the US. So despite that negative news flow and those real impacts on people's ability to actually go out and spend and keep the economy afloat, investment markets seem to have completely just battered it off, and we've had positive returns. It hasn't been a smooth ride. There's certainly been moments of high levels of volatility where it feels like the market's doing this, but end to end, the outcome's actually been quite positive. And that feels a little bit strange given that negative news flow. And you wouldn't be considered unusual if you thought that was strange, because it certainly is. We are concerned at the moment that perhaps the market is getting a little bit ahead of itself, and that it's not appropriately pricing in some of the risks that are actually on the horizon, particularly with regards to if we do move into a recessionary type environment, the earnings profiles of businesses, and therefore how much that stock price can go up, would be quite limited. And we're not necessarily convinced that that's been fully priced into the market. So I think what we should be doing from here, right, is let's step through what's happening in the economy and how that can translate into investment markets and then ultimately your portfolios. The big ticket item over the last sort of 12 to 18 months has been inflation. Now, we've had really high inflation rates here in Australia, but they've actually been eye-watering in places like the US and Europe, where they hit close to 10%, and in some places in Europe over 10%. Now, that actually started the entire bandwagon of central banks, so the Reserve Bank here in Australia and the US Fed over in the US, increasing interest rates. And the reason why they do that effectively is that one way to get inflation under control is to increase interest rates and deliberately slow the economy down. By doing that, you then start to get price corrections come through. Now, what you'll actually see here is the blue line is headline inflation. That is the inflation that is the CPI number that you'll hear on the news when they're talking about the inflation figures. As you can see, this is a weighted average of the major advanced economies. It has come down. So the interest rate increases that we've been seeing around the world have started to play their role in slowing the economy and slowing down price movements. However, the black line is core inflation, and it is arguably more important. What core inflation does is it takes that headline number that you hear in the news and it takes out the volatile items. So it takes out things like energy and food. And the reason for that is that we can get price variability in those items that are seasonal, that are there one month, gone the next. So core inflation gives you a much better understanding of the general trend in price movements across the board. And this is actually the number that the Reserve Bank, the US Fed, all the central banks around the world will be focused on when setting interest rate policy. So you'll often hear in the news, inflation is coming down and therefore central banks should be able to pause. The reality is core inflation is still very, very high. And in a lot of instances, it's actually above where central banks are targeting. So here in Australia, for example, core inflation, so the RBA here in Australia is targeting an inflation rate between 2 to 3%. Core inflation is at 4%. So it is above that target range, which means the RBA still has some work to do. The US is in a similar position. They still have core inflation at a reasonably high level and further work that they may need to do with regards to interest rates. The reason why markets have been actually so volatile is because the market knows that central banks need to increase interest rates to get inflation under control. However, they seem to be changing their mind very, very constantly with regards to whether or not interest rates will continue to rise, whether they'll pause, or whether we'll actually get interest rate cuts. These charts here, these should theoretically be the most boring charts in the world. This is the Fed funds rate, forward curve rate. So effectively what it does is it's the market saying from this point on, what interest rate increases or decreases do we expect the US Federal Reserve to apply over the next 12 to 18 months? And what you can see, I don't know if you can see my pointer on the screen. Can you see my cursor? You can, brilliant. Okay, so what you can see here is that if you go back to the beginning of January this year, the market was expecting that the Fed would have to continue to increase interest rates up until about mid-year, and then they would start cutting rates because inflation would be under control. So fast forward only a few months later, so March, and all of a sudden the market is assuming that, well, actually, the Fed is going to have to increase interest rates for longer and probably keep them higher for longer. Go forward to May, and all of a sudden, the market's like, nope, the Fed's going to start cutting. So not just that they were going to pause, but they'd actually start reducing interest rates. And you can see, if you move forward now to, this is the most recent one, again, the market is assuming that there's going to be significant interest rate cuts occurring over the next sort of 12 months. Now, that's really interesting because normally these curves do not move very much at all. So the market is trying to get ahead of itself in understanding exactly what happens to interest rates. The reason why that's really important for the returns that you see in your investment portfolio is that when you're actually valuing an asset, you have a look at the cash flows that that asset can earn, and you discount them back at the prevailing interest rate. Now, obviously, the market would much prefer if they can discount it back at a lower interest rate because it makes the assets more valuable. So when we get into a situation where the market is assuming significant interest rate cuts, it allows them to place higher valuation on assets. And that's why we're seeing that sea of green in equity markets. Our concern is, though, the reality is with core inflation still above the target of most central banks, it is difficult to see how they can actually start to cut rates, let alone pause. So there's a big difference between pausing and not doing any more hikes versus actually cutting. The reality is, if the US Fed or the RBA here start cutting rates, it's because something has gone horribly wrong and they're actually expecting economic pain to start coming through in the economy. So if we move forward into where we're at, and I'm going to focus on the US here, and the reason why I'm focusing on the US is that the US 10-year interest rate is referred to as the global risk-free rate. So it is the risk-free rate of all assets price. Okay, so it doesn't matter if it's an Australian equity asset or a UK asset, it has a look at what is the global risk-free rate. What could I invest in and get risk-free at this point in time? So what happens to interest rates in the US is hugely important for investment markets. And as you can see, so this is just the US CPI, and you can see that, again, their core inflation, their headline inflation is under control at 3% there. But core at 4.8 is well and truly above that 2 to 3 band. So the market is really probably getting ahead of itself, thinking they'll cut. And if anything, it's likely that there might be another 1 or 2 interest rate increases to come out of the Fed. And the reason for that is that the labor market is actually really tight. So what's been interesting is that this here, you don't need to really sort of understand the details of this graph other than this is what we refer to as a forward-looking indicator of the probability of a recession. So when this line is below the zero, the market is telling you there is a high probability of a global recession occurring. Now, what you'll see is that this line crossed over the zero line about 12 months ago. It's extremely unusual to have a period where the market is signaling a recession, the bond market, and it doesn't actually occur. So that then becomes interesting for the pricing of assets, because on one hand, the bond market is telling us there's going to be a recession, but the equity market seems to be completely ignoring it, and assets are still being overpriced. And the reality is, what's a bit different about the way this market cycle is playing out is that despite the fact that we have rising interest rates, we have slowing GDP growth, there is a huge level of sort of tightness in the labour market. So what I have here is the US labour market, and you can see the blue line is the number of unemployed people. So at the moment, at the moment there are only 6 million unemployed people in the US. So these are people who are actively looking for work, versus the number of job openings at 9.8. Currently, there are physically not enough unemployed people to fill the roles. So unemployment, like here in Australia, is actually extremely low in the US and in a lot of developed countries. The problem with that is that then starts to put pressure on wages. So in the US, if you actually want to hire staff, the only way that you can attract staff is actually by offering them more. When you actually get wage inflation, that is a central banker's worst nightmare, because the only way to get wage inflation under control is to slow the economy and almost deliberately cause a recession to stop that wage price spiral. So that has been the real concern in the US, is that wages have been out of control. They've certainly come in and moderated, but with a really tight labour market, it's actually difficult to ignite a recession when people have jobs. The US is in a slightly different position to us as well, in the sense that their mortgage market operates very differently to us. So they can take out a 30-year fixed rate mortgage. We cannot. So for them, even though interest rates have been increasing, the fact that they still have a job, there's no real impact on their wealth outside of inflation. So with inflation getting under control, interest rates, they've locked in a 30-year mortgage and they've got a job, they can kind of still sort of march on. So it's making it a very difficult cycle for the central bank to actually get inflation under control. If you compare that to what's happening in the Australian market, so on the left-hand side, I have the unemployment rate. So you can see that we also have really low unemployment. We're at 30-year lows from an unemployment perspective. What's been really interesting in terms of what has been impacting those employment levels has actually been the participation rate. COVID seemed to have caused a change in the way people interact with the labour market. And at the moment, we're uncertain as to whether or not this is a permanent change or whether it's actually something that will eventually work its way out. What you can see here, so the participation rate is effectively looking at the number of people who are actively wanting to work. They're participating in the labour market or they're actively seeking work. When COVID hit, the participation rate obviously fell quite considerably. Since then, though, it has moved up, but as you can see, it hasn't gone back to long-term trends. Particularly when you have a look at Australia versus the US. What seems to have occurred is that there is a cohort of people, usually in the 55 to 65, that have actually chosen to step back from the market. So COVID seemed to have changed the way, or their lifestyle choices around, do they want to retire early? And because we had significant increases in share prices coming out of COVID, their pensions were at a level that actually made it quite feasible for them to do that. So it's really interesting in the sense that whether it's the RBA or the Fed, their ability to fight inflation also depends on what the consumer's doing. Now, if you still have a job and a recession hasn't been ignited, it comes down to then how are consumers spending their money, and are they going to continue to put pressure on prices that would ultimately then need to feed through into further interest rate increases. So Australia is a little bit different from the US in terms of, so even though we've got that really low unemployment like they do as well, we haven't had the wage pressure here. So as you can see there with the blue line, our wages, most central bankers would say that wage inflation between 3 or 4% is perfectly fine. And that's the zone that we're actually in. So what that effectively means is we don't think the Reserve Bank of Australia will need to go as hard with interest rate increases as what the US Federal Reserve has. So that is helpful for people with mortgages and debt levels. But ultimately, as I mentioned, what happens to the US level of interest rates is profoundly important for what actually then transpires in investment markets. So while we may not have what we refer to as a technical recession, so the economists in the world will say you need 2 consecutive quarters of negative GDP growth to be in a technical recession. Well, that's fine. But as investors, what really matters for us is that, well, what about the earnings of companies? So even though we may not go into a formal technical recession, is it possible that the businesses that we invest in an attempt to actually grow your wealth could actually see an earnings recession. So it's difficult for them to generate profits that could then ultimately be passed on to shareholders. And one of the areas that we look at to understand that is really what's happening with the consumer. And what you can see here, whether it is Australia or the US, is the consumer is slowing. Now, there was this huge spike up around COVID because everyone was at home and they were bored and they were online shopping. Okay, so there was this sort of unusual spike up in spending patterns, but they have started to come back down to more normal levels. But as you can see, if you have a look at, for example, the blue line, which is the Australian one, and if you look at that relative to history, it is now starting to slowly dip below historical levels, which means the consumer is starting to put the brakes on. There's been a lot of talk in Australia about the concept of a mortgage cliff. As I mentioned before, it doesn't really exist in the US because of 30-year fixed rate mortgages. But here in Australia, a lot of people locked in 3-year fixed rate mortgages, they are starting to roll off. That is going to have an impact on people's disposable income, the amount of money that they have left over to spend on things other than their mortgage. And with inflation still reasonably high, obviously their local grocery bill each week is higher. I know I go in and my little green bag and I walk out and it's full and I've spent $100, but I can only feed the family for one night. So it's kind of it's a very difficult environment from a consumer perspective, and we can see that pressure is starting to come through. The other area that we can see it coming through is if we have a look at personal savings. So a lot of people built up savings during COVID. Again, even though we're at home spending, there was oddly an increase in income for a lot of people. So some people on the benefits that were being paid by governments actually increased their overall level of income, and hence we saw a general spike in the savings rate. What you can see now is that both here in Australia and in the US, that has now dipped below long run averages. So people are now drawing down on their savings in order to support their spending patterns. And that includes with them actually reducing their spending. At the same time, we've seen a huge increase in credit card balances. So once again, people are now moving into the pattern of spending money that they don't have. Sooner or later, that is a game of musical chairs that will actually need to stop. When it stops, that becomes problematic for businesses in terms of their earning capability, problematic in terms of their future growth prospects, and therefore, as investors, what we should pay for their share price and what we should expect from dividends and so forth from those particular companies. So that gives you a general understanding of what's happening in the world. And as I mentioned, there is some negative news flow out there. And that doesn't mean as investors that we need to necessarily be concerned and run for the hills. It just means that we need to understand where we should be looking to invest and how we understand and account for risk in the way that we invest. And I think what's probably a good point here before I move into what we're seeing and what we're doing in investment markets is to give you an understanding of the way we think about investing, because that is really, really important. So there's one thing I know for certain is that I can sit here and I can say to you, oh, there'll be a recession next year. Right? The one thing I know for certain is that I'll be wrong. I will be wrong in terms of the timing, the magnitude, etc. While it's great to have an opinion about the macro, about the where interest rates are going to go, when inflation will peak, will there be a recession? If so, how long? It's something that is extraordinarily difficult to get right with any level of consistency. So to purely base your investing around what you think interest rates or inflation or so forth might do is sometimes a bit of a fool's errand. It is prone to mistakes. What we do when we're thinking about investing is that we know that ultimately the value of any asset is the cash flows that that asset can generate and the growth of those cash flows. I often say to people, if you think about the local corner shop, if you decided you wanted to go and buy the local corner shop, the first thing you would do is you would have a look at, well, what cash does this shop bring in on a regular basis? You would then think about, could I actually reasonably grow that by, making some changes, putting, paintings up, doing bits and pieces? From your understanding of the cash flow that comes in, your ability to grow that cash flow from changes that you'll make, that will determine how much you'd be willing to pay for that corner shop. You're not actually going to use elements like, oh, but my friend really likes the position, or across the road there's a lovely tree. Really sort of bizarre, nice to understand, but doesn't actually impact the value of that business. So we know that the value of any asset is the cash flows it can generate and the growth of those cash flows. And I'm going to show you that that also extends through to equity markets and to every other listed market. What I have here, and I've used the US market because it is the market for which we have the longest, richest data for. And if we have a look at it over this extraordinarily long time frame of, over 100 years, we know that on an annual basis, the market grew by 9.1% per annum. So that's 9% return every year for 100 years. What was that actually made up of? Well, the first element is inflation. So we know that most businesses do keep pace with inflation eventually. So going back to and why wage inflation is such a problem, if your costs are increasing because you're having to pay more wages or it's costing you more to buy in the goods that you ultimately then on sell, eventually you increase your prices to keep pace with that so you can maintain your margin. So inflation of that 9.1 accounted for about 2.1% of that return. Oh, wrong way, sorry. Total payout yield. So think of this as basically any cash flow that the stock market is throwing off. So dividends or buybacks. So occasionally companies will actually offer to repurchase your shares from you. So at any time that they're using their underlying cash flow to send it back to shareholders, and that accounted for 4.9%. And then the growth of those cash flows. So if a company is not paying out dividends, it is reinvesting those cash flows with the prospect of actually hopefully growing the business. So like the corner shop, putting some paintings up or, changing the counter or the fittings, etc. Now, the growth of those cash flows accounted for 1.6%. So therefore, the cash flows, the growth of those cash flows in nominal terms, so in other words, accounting for inflation, accounted for 8.8% of that 9.1% return. So this is why you'll often hear people say markets are efficient. They are. People are not silly. They understand that cash flows and the growth of those cash flows is what is absolutely key and fundamental. So rather than focusing on what interest rates will be or inflation or so forth, what we focus on is the cash flows. What are the cash flows of those assets and how could those cash flows grow over time? And by using that as our anchor point for everything that we do from an investment perspective, it means that we are looking to buy assets that are undervalued. So in effect, can I buy $1 worth of assets for 50 cents? Because the market has gotten a little bit confused about things because it's focused on the wrong elements. It's focused on the negative news flow. It's focused on, the corner shop that has the lovely house next door and therefore somehow that'll add value. So even though they're really efficient over the long term, we know that they're not efficient over the short term. This line here, so the green line is showing you is that if I know with perfect foresight what the growth of the cash flows are, the cash flows and the growth of those cash flows and discount them back, the green line is what the market should have done. And it's the line that we showed you on the previous chart. The over rolling 10-year periods, though, this jagged blue line is what it did. So as you can see, the market very often doesn't reflect the true value of the assets. And the reason for that is because humans are involved. We are emotional beasts, okay? We hear our Uber driver giving us advice on crypto and we feel like we need to go and buy it and so forth. So markets are very rational and efficient over the longer term, but over the shorter term, behavioral biases come into play. So as investors, we want to take advantage of those behavioral biases. So in periods like at the moment where there is negative news flow, that actually can create opportunities for us because we can determine where people have gotten too concerned and they've thrown the baby out with the bathwater and they've assumed that an asset is going to completely devalued. And we can then hopefully pick that asset up at a much cheaper price. So when we're investing, this is a very stylized sort of version of what the stock market does. The dotted purple line is, let's call it the fair value. So it's what the asset is really worth. The green line is what we would like to buy it for. We call it a margin of safety. And the reason why we have a margin of safety is that, so if we've worked out that the asset is worth $100, we don't want to buy it for $100 because the reality is the future is uncertain. Okay. So even though we have an understanding of how those cash flows may grow, the reality is those cash flows could get impaired in one way, shape, or another. So we want to make sure that there is a margin between what the asset's worth and what we buy it at in case something goes wrong or something changes in the environment that we're not uncertain about. So, but what we do know is that if we pick up an asset at this point, the reality is the probability for losses, so the probability that the asset will keep falling as our people are emotionally selling it off, is actually quite low, remembering that very few assets go to zero, because if they get cheap enough, private equity comes in and takes them over. Versus if we're listening to our Uber driver and going off to buy crypto when it's all the way up here, the probability for future returns is really, really low because it's already an overvalued asset. However, the probability of losses is extremely high. So when we're investing, what we're trying to do is get the odds in our favor. We want to reduce the probability of loss in the portfolio. That's not to say we can avoid losses. That is, it's not possible to do that. But by avoiding assets that are overvalued and focusing on assets that are currently being undervalued, we increase the probability of future gains and decrease the probability of future losses in the portfolio, which hopefully you do see play out, and they have certainly played out in our portfolios over time. So as investors, and again, going back to that whole behavioral biases, we're all subject to them. I'm subject to them. We all are. But what's important is that we understand those behavioral biases and that we can give ourselves a little bit of a reality check and think through what's really important. Have we got the right perspective here? And even though things are looking great from an investment market perspective at the moment, we do, as I mentioned before, feel that the markets have probably gotten ahead of itself. And it's quite possible that we could see some repricing come through, particularly as the market starts to price in a recession and what that might mean for the earnings of businesses. Even if we do go into a recession though, and even if we do see a sell-off in markets, it's so important to keep that into perspective. What I have here is I'm showing you going back through time, stock market bull and bear cycles. So the blue bars is stock market bull markets, right? So that is basically when the market is just constantly grinding up. And you can see there, the levels of return can actually be quite high, okay, during these periods. Bear markets, which are the red line, the red parts below the line, as you can see, when they're occurring, bear markets are not fun. It does not feel great to look at your portfolio and go, it's 10% less than it was last year. But there's one thing that is often repeated is that bear markets are actually quite short-lived, and the depth of the bear market is certainly not as big as the upside in a bull market. So if you have a look at historical bear markets, they can fall anywhere from 22% all the way down to 57%. So if you remember back to the GFC, if you're sitting there and your portfolio is halved, if you've got just equities in the portfolio, that is really not a great feeling. However, they only last anywhere between 6 months to 2 years versus the bull market phase, which can last anywhere out to a decade. And generally, we see price increases of between 400 and 530%. So the reason why I'm showing you this is that when you do get nervous, it's really important to remember the value of staying invested in markets and leaving the risk management up to investment professionals so that we are actually focusing on having you in undervalued assets that are likely to gain and not as likely to lose value versus and avoiding those overvalued assets that have a higher probability of loss. This chart shows you, if we go back to the GFC, well, if you were, often investors are their own worst enemy and they make a decision to pull out or change investments at exactly the wrong time. This shows you that if you are during the downturn, if you sort of hit the bottom and you eventually just went, okay, Shannon, I'm done, I'm out, I can't cope, can't sleep at night, these losses are terrible, and you decided to go completely to cash and stay there. What you'll find is that your $100,000 investment will end up, over a 20-year period or close to a 20-year period, you'll only have made $17,000 because you would have incurred these losses and locked them in. If you thought you'd be clever and say, okay, I'm out, but I'm going to tell you when we're going to get back in because I'm going to be able to time this perfectly. And let's just say you tapped out of the market, sat in cash for a year, and then all of a sudden things are looking great again. So in you go. Your 100,000 would have become 259,000 versus if you actually just put your portfolio in the drawer, leave it to Shannon to keep her eye on and to us and come back to it at the end of this time period, you were up over 400,000. Now, it's really hard because, there are emotions involved. This is money. This is real life. This is an emotional topic. But understanding the way that you're invested, being invested in a portfolio that is actually focused on minimizing the downside risks is actually really important for wealth generation. And the reason for that is that people often forget about, I've got young children and they think I'm a complete nerd because I kind of say to them, the most important lesson in life you'll ever learn is that of compound interest. So I've given them a little savings account and I put money in it. And one of them said to me not long after it went in there, she's going, Mum, you've put $100 in here, but now it's got like $101. What happened? I went, your money made money. So just explaining that concept of compound interest. The reality is, though, compound interest is more powerful on the downside than it is on the up. So if you consider this bar here, for example, let's just say that you have $1 invested and that dollar loses 50% of its value. So think of, the GFC type market. For you to get back to square, even though you've lost 50%, it's not 50% that you need to make up. It's actually 100%. So when you think about it, to make up 50%, you need to make 100%. That means you've either got to have an extremely long horizon or willing to take on huge amounts of risk in order to make that back up. So the lesson here is that as investors, we will often miss the top of a bull market cycle. And the reason for that is because the assets are becoming overvalued. So the probability of loss is getting high. And we know that if you start to lose money, making it back is extremely hard. When we have market downturns, by not falling as much, by having the portfolio grip, we start compounding from a much higher base. And it shows us that that actually is a lot more impactful for wealth generation. So here is examples of the portfolio, and I've used our growth risk profile portfolio that it will be used for some of you, I'm sure. The blue bar is showing you periods of the worst drawdowns through time. So the worst 3 month, 1 year, 2 year, 3, 5 year drawdowns. And that's for our capability. The green is the average manager out there. So what you can see, because of the way we invest, our portfolios do not fall as much during these periods. If you have a look over the 1 year, for example, when we had sort of huge sell-off as the market sort of started repricing, interest rates increasing, our biggest drawdown was 6% compared to 10% for the peer group. So that, as we know, because of the power of negative compounding, can be quite impactful for overall wealth generation. So my message here is, be informed, but don't be reactive. Be mindful of the way we're investing, being mindful of the risk itself. And for you, the question becomes, am I in the right risk profile for the stage of my life, etc.? And they're the conversations that you should be having with Shannon and the team. Okay, so where are we at the moment? What are we doing in the portfolio? So given that there are some concerns out there from a macro perspective, but as I said, that can also create opportunities. Unfortunately, it hasn't created a lot of opportunities yet. We're still waiting for a big leg down that will, people say when the markets are in the red, oh, Jody, are you guys stressed? I'm like, no, this is fabulous. This is like sale time. It's like the Boxing Day sales. I get to buy things at half price. It's fabulous. So we haven't quite gotten there yet, but there certainly are some opportunities. And, we often say, valuation, it's kind of like understanding cars, right? If you know that you're a city driver, then having a big four-wheel drive or a big ute that you would usually go bush bashing in to drop the kids off at school is probably not the right environment for that particular vehicle. Versus actually, if you live in the country and you've got to get around on your farm, having a sedan is probably not the right option either. So it's really important that even if something is cheap, that it is actually fit for purpose for the environment that we're actually in. So while I said it's really difficult to actually understand where interest rates and inflation might be going, it's really important that we understand the temperature of the room that we're standing in and therefore what risks may be building. So what we've been doing in the portfolios at the moment is making sure we've got a good combination, because there's a lot of different paths that we could take from here. We may end up in a recession. We may not. We could have a hard landing, a soft landing. We could end up in the worst case scenario, which would be stagflation. Stagflation is where we have inflation and no growth. So as individuals, we go backwards from a wealth perspective. So because of the different possible paths that the economy could take, it's important that we've got different tools in our portfolio to account for that. So we have a combination of things. We have things in there that we refer to as return seeking. So these are the assets that we know are cheap. So we're going in and we're buying these assets, so the dollars worth of assets for 50 cents. There are others that we're looking for return consistency. So these might be assets that are not hugely cheap. They're relatively attractive, but they're your boring plod along things, and that's fine because we're trying to achieve a CPI plus outcome for you. So we need things that are going to be constantly chipping away at that objective. We then need assets that are going to provide diversification. And why that's important is that, as I mentioned, the assets that you want during a recession are different to the assets that you would want during a period of growth. Now, we could end up in either of those scenarios. So ensuring that we've got enough assets in the portfolio so that we can win irrespective of the market environment is really important. And there are some assets that we have in there that protect against specific scenarios. So if you go back sort of 12 to 18 months ago, we had inflation protection assets in there. We've sold out of most of those because the reality is you want inflation protection when nobody else wants it because then it's cheap. Now it's actually very overpriced. So to add it into the portfolio at the moment, it'd be like overpaying for insurance effectively. But there are other elements that we can consider and put in. This is a very stylized version of where we're seeing opportunity at the moment and how you would have noticed it evolving in your portfolios over time. For those of you who may have been investing in our portfolios for a little while, you would have noticed coming out of COVID, we had a really big holding in energy. So that was a classic example of baby out with the bathwater. The energy prices were down to $20 a barrel. You remember those days? Versus, now where it's 100 and you go to the petrol pump to fill up and it feels like highway robbery. We bought that asset though when everybody was assuming, and this is where the behavioral bias comes in, COVID had people in lockdown. So the market basically made the assumption that people were never going to leave their homes ever again. And not just to mention the fact that we wouldn't travel, but we'd never use petroleum in most of the products that I'm sitting in this room on. Petroleum is used in a lot of manufacturing. So we knew that the market had completely mispriced that. That has played out. We've seen some extraordinary returns from there, and that is basically coming out of the portfolio as we're using that to fund ideas. Japanese financials has been another area. So even though Japan as an economy hasn't grown for a really long time, because they have such a low level of interest rates over there, they only needed to be able to increase, so banks in particular, increase interest rates a little bit to have a huge impact on their profitabilities. Again, that has played out. And Japan was actually one of the better performing stock markets over the last 12 months. World Communication Services. So this includes things like Google, Apple, so forth, Facebook. We actually piled into these at the beginning of the year, and this has played out really quickly. So these, when interest rates started to go up, these stocks being growth stocks, and of course you're discounting those cash flows at a higher interest rate, fell considerably. Facebook, for example, or Meta as it's now called, fell by 60, 70%. So we were quite happy to buy it when it fell to that. But now, because of AI and everyone's talking about the AI revolution, these stocks have soared again. So again, we're taking profits and moving them out of the portfolio. If we go down to the other end, the areas that we're leaning into the most at the moment would be emerging markets. So emerging markets is one of those areas that has been sold off quite considerably. And examples of that include things like China tech. So China tech is that China has, we're talking about the Amazon equivalents or the Spotify equivalents in China. Now, these are small holdings because obviously there's a lot of regulatory risks that actually come with those. But again, they've done really well and they're starting to mature and will start to take profits. Bonds in the portfolio. We didn't hold a lot of bonds in portfolios leading into sort of 2022. Now, for those investors who are in more conservative risk profiles, a lot of portfolios that are conservatively invested will have a high holding in bonds. Now, the reality was with central banks holding interest rates at zero, bonds were completely mispriced. So we had a preference for cash or very short dated bonds in the portfolio. Now that interest rates have increased, those assets have been repriced, and they do play a very important diversification role in the portfolio. So if we do step into a recession, bonds are the assets that you want. Bonds hold up really well during a recessionary period. They don't hold up very well during inflationary environments, but that has actually started to work its way through in the pricing, and hence why we're increasing exposures there. Other areas that are becoming interesting is areas like US financials. So most of you would have seen the collapse of several US regional banks at the beginning of this year. And that caused a huge repricing of banks across the board. The repricing of large cap, the big institutions over there was overdone compared to the regional banks. So the issues that the regional banks got themselves into, which was effectively poor risk management on their loan books, is not something that we expect to see in those larger banks. But the market actually just allowed that pricing to flow through. So we've actually started to increase our exposure in that particular area. And REITs, which is real estate investments, so listed real estate investment, as we start to see property prices be revalued and adjust with inflation, with the way people change the way they work. As you can see, I'm working from home today. So therefore office space is not as much demanded as much, etc. That has started to be repriced in these assets. So they are becoming cheaper, and we are starting to dip our toe in the water there with those particular assets and capabilities. But as I mentioned, it's important to think of the portfolio as a whole, and have we got stabilizers in the portfolio? So there are areas where, so the red here, so some of the positions we have like emerging markets or global banks, if we get a big cyclical downturn, they're not going to do very well in the portfolio. However, we've got a whole bunch of counter-cyclical holdings in the portfolio to offset that, being interest and fixed income, both here domestically and over in the US, and even currency. Holding the US dollar is actually a really nice diversifier in portfolios, because when you get a recession or a cyclical downturn, the US tends to be a flight to safety. So a lot of capital goes to the US, which causes the US dollar to appreciate, and therefore you're in an asset that's going up in value. And then obviously making sure that the valuation expectations are, at least fair value or attractive to very attractive in the portfolio. The takeout points for today, before we open up for questions, I assume we'll open up for questions, is that, interest rates increasing has really changed the backdrop with regards to assets and an understanding of risk. Effectively, with interest rates being held at near zero levels by central banks for the best part of a decade, it has had an impact on the way markets have priced risk. And risk was effectively mispriced. That is now starting to work its way through the system, and therefore having an understanding of risk management in a portfolio is really, really important. It's important that we make sure a portfolio isn't set up to win just in one environment, because the reality is we don't know what the environment is going to be. We need to be set up for different environments, and we need to make sure, and while we might have a view on which environment may play out versus another, we can tilt the portfolio to the environment that we think has the higher probability of actually playing out. But most importantly is for you to remain focused on your plan, what your strategy, what you're trying to achieve. Are you in the right risk profiles, and not about trying to time getting into and out of the market, and knowing that that focus from a risk and valuation perspective is really where we come in and assist in these portfolios, where we're effectively looking to buy cheap assets that are high quality assets that eventually the market will recognize and reprice to their fair value. So thank you for listening to me today, and happy to open it up for any questions.
Yeah, so if you'd like to put through any questions, there's a few there, so I'll just go through those. But if you've got any questions, please do use, this is your one and only, opportunity to have access to asking Jody those questions. So I guess just on one of the questions was talking about what is going to be the impact, or someone's asking the impact on a number of companies are actually stating that they're going to be letting go large volumes of people. So CBA 350. Yep. I think NAB a couple of hundred, Telstra, what was Telstra's 500, but what is the impact on those, and is that going to push us into a recession with those?
Potentially, and this is the way monetary policy works and the way it feeds itself into the system. So obviously we feel the increase in interest rates for our mortgage payments, but businesses feel it as well. So every time a business wants to do something, whether it's, CBA is obviously, slightly different beast in the way in the markets it's operating in terms of borrowing and lending. But any business, if they want to expand or they want to do something, they have to actually get access to the funds. Now, in a world where interest rates are increasing, it becomes more and more expensive to access capital to then invest in your business. So the first thing that tends to go is capital investment. And that's really started to play out in the sense that companies no longer start, well, they're not going to expand. They were going to open up X more stores, but we won't do that now. Then when the consumer starts not spending, as we saw earlier, it then hits into the next level where actually we've got too many staff. We're not making as much sales as we used to. We've got too many staff. We have to make cuts. This is the unspoken result that the central banks are actually aiming for, right? They will never come out and say we're trying to cause a recession or unemployment. But the reality is, by increasing interest rates to slow inflation, you only slow inflation if you actually slow economic activity. So the question becomes whether or not they can walk that fine line of slowing the market, the economy down enough to cap price increases, or whether it's too much and tips us over into a recession. Unfortunately, central banks do not have a very good track record of being able to orchestrate a soft landing. The US, for example, of the last 15 interest rate increasing cycles, 13 ended in a recession. So it's not necessarily something central banks are very good at. However, as I said, even if we don't end up in a recession, the earnings becomes important for us. So when you think of whether it be CPA, Telstra, or so forth, they're laying people off because they're not earning as much. So therefore, as an equity holder or a debt holder or so forth, you start to become concerns about whether or not you'll be able to get a return out of that particular business. They're obviously trying to ensure they can maintain their returns by reducing their cost base. So the answer is it certainly could be the beginning of us being pushed in, and why when we see all that sea of green in markets for the year to date, it kind of doesn't gel with regards to hearing the rhetoric from companies that they're starting to struggle, they're having to lay people off, they're stopping expansion plans, right through to sort of what's happening economically.
Do we have any other questions? I think you must have answered a lot of people's questions as they went through, because
I sent them to sleep. One of the
There is another one. I just wanted to pop through to Jody. Which particular spending should we be reducing to help our interest rates hold?
Sorry, say that again.
Which particular spending should we be reducing to help our interest rates hold or not increase? Help our interest rates not increase.
Oh, so the RBA won't increase it if...
Yeah, so which particular spending, like as examples?
Yeah, so what, it may or may not be spending. So I'm just going to flip back through to, so what the central bank will do is they have two mandates, effectively. One is full employment, tick, we're there. The other is price stability. So when we're in a situation, sorry, let me go back to here. When we're in a situation of full employment, but we don't have the price stability, and is this the, sorry, where's my other one? Sorry, trying to find the inflation rate. No, don't have it there. But we don't have, oh, sorry, there it is there. What am I? Price stability, so you can see that that's sort of the inflation rate. That's a bit old, actually. It hasn't got the last couple of data points in it. Then what will actually happen is they'll focus on price stability. So they're focusing on getting inflation down. Now, with inflation currently, core inflation, so that'll include things like, and we've felt it, right? It's our utility bills that all just went up and so forth. That is what is keeping core inflation high at this point in time. It's the services industry, effectively. they will be focused on that and making sure that comes down. So even though they paused at this meeting, I don't think too many commentators think that they're done yet, effectively. Monetary policy has very long lags. So all of these increases that have occurred, they take a while to work their way through. You know, for me, for example, my fixed rate doesn't roll over until the end of next year. So it's fine for me. But by the time I get towards the end of next year, if rates don't start coming down, I'll be like, oh, okay, right, I'm going to have to start, you know, changing a few things around. So it's not necessarily our spending patterns per se, but it's rather, are the businesses passing on input cost prices? So the fact that we're going out and we're quite happy to pay, you know, huge amounts of money for a meal and then tip the waiter at the end, sort of a big amount as well. It's that wage pressure that needs to sort of come out of the system. You know, as I showed you in the personal savings rates, they are actually coming down, and spending rate patterns are coming down as well. So in a sense, it's all of us actually being a little bit more prudent, and for the RBA to see that spending is coming down and that pressure on prices is actually starting to moderate. The biggest problem, and because we haven't got the wage pressure here, that is quite an advantage. What you'll find is that it might naturally start to slow even more, because typically, even though we had recent big increases in award wages come through, and that can be problematic because it sets up expectations, the reality is most of the wage increases come when people change jobs. Okay, so if I don't necessarily get a big increase from my current employer, but if I go and move from this employer to that employer, they're going to pay me a premium because they really want me to come over there. What tends to happen is that if people are starting to get paranoid about the economy, they're less likely to go out and want to start changing jobs. So that in itself could actually be quite advantageous for the Reserve Bank, in the sense that it keeps a lid on wage inflation. And if we've got that lid on wage inflation, and we see inflation falling elsewhere, so it's important what's happening in inflation in other countries, because often we're buying services off them, or we're getting input, goods that we use in our manufacturing process into them and so forth, or we're importing their inflation into our country. So in some respects, the RBA can let the other central banks like the Fed do the heavy lifting for them. However, there's still probably a little bit of work left to go here in the Australian market, unfortunately.
Thanks,
I've got another question. Very good question, actually. This question that someone's put out. What will be the influence of significantly increased Australia-US debt and interest going forward? That's a very good question, especially when you look at Victoria, isn't it? When you think of the debt that we've got here. But what will be the influence? I guess the influence of that going forward on the investment markets?
Yeah, that is a very good question. So there's a couple of schools of thought around this one, right? So the first is that there's a theory out there called the modern monetary theory, which basically means just print money. It's all right. Don't worry about it. And the idea is that a sovereign nation can't go broke, right? And what I mean by that is that if Australia goes out and borrows money and we've got to pay that money back, well, we can actually just literally issue more dollars to pay for it. However, it does cause inflation, right? So there is a point, if you've got decent productivity, it's okay, but there is a point to which, sorry, it's my vicious guard dogs barking in the background, a point to which that will tip over and become inflationary. The reality is, though, we're unlikely to see sovereign governments go broke. It becomes more of a problem for Europe, where they've got a common currency. That's why it's potentially a failed experiment, the whole euro, that will play out at some point, I'm sure. But what effectively is likely to occur is that even though the governments can still service those debts, it will actually put a dampener on the fiscal policy spending that they can do going forward. So if we do end up in a recession, we know that it could actually be sort of reasonably nasty, because central banks are not going to be able to take their foot off the pedal while inflation's there, and that federal governments, whether it's the Australian government or the US government, are not going to be able to go out and just keep spending, because their debt levels are just too high for it. So it's not necessarily a problem in terms of we're going to go broke. But it is a problem in terms of if the governments then stop investing, then that starts to cause a problem with regards to capital flowing through the market and what people are willing to pay for assets. And we'll see a revaluation of assets occur.
Great. Well, if we have any more questions, otherwise, I want to say a huge thank you to Jody and Richard for making the time to join us today and go through and give us a personal briefing with our clients. You know, I'm always at the front row every time you're speaking, Jody. So, you know, I am. And then I come up with 50 questions afterwards. So thank you so much. I know that we're very special to have this. I know that you normally only present to actually advisors. And it's just been really great to, I love the way that you actually take what are, you know, complicated, very technical issues and try and bring it down so that all of us can understand it and understand what's going on in the markets. Because I think the more I, you know, research and learn about behavioral finance and how it impacts with the actual markets, and you've shown that with your graphs as well, there are actually now is a bit of an opportunity for us, I guess, in the markets, not to panic and try and control our behavior around that. So thanks very much, and thank you everyone for joining us. We will email out this presentation and the video should you require on a Friday night. I'm sure it's better than Netflix. You've seen everything, but it's yeah, hopefully you've got some education out of that and can feel a bit more calmer with things going on in the market. So yeah, thanks everyone for joining us.
Thank you.